Hey everyone, today's Real Vision Daily Briefing is sponsored by Engrave, maker of the coldest hardware wallet Zero and stainless steel backup graphene. Engrave brings you the highest security in a touchscreen experience to safely manage all your crypto offline. Enjoy a 10% Real Vision discount in engrave.io shop with the code RealVision. Now to the top analysis of today's markets. What does the Fed mean for your money? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Sven Henrich, founder of the NorthmanTrader. Hi, Sven. Welcome back.
Hi, Maggie. Good to be with you. Thanks for having me.
Welcome back to Real Vision. I think this might be your first time on the Daily Briefing. If not, it's been too long. So we're so excited to have you today, which is turning out to be quite a day. If we look across the action, it's looking like the Fed's not very good for your money if you were holding U.S. stocks today. Stocks fell across the board. In fact, we saw that sell-off seemed to accelerate into the close. We've got the NASDAQ down over 2%, about 2.25%, Russell down 2%, S&P down a little over 1.5%. We've got the VIX up. So in the 10-year, looks like retreating down below 4%. So investors digesting not only the latest Fed meeting presser from Jay Powell, also a lot of earnings. So a lot of this sort of feeding onto each other. But let's start with the Fed. Looks like March is off the table. What jumped out at you? What did you make of what we heard from Jay Powell?
You know, I'm usually somewhat known to be critical of the Fed. And in particular, over the years, there are various policy areas, if you will. But I have to give Powell credit a little bit because he actually stuck to his guns for once. Whether that's turning out to be sustainable, we shall see. Look, in December, we had, following the October lows, we already had a massive easing in financial conditions. And Powell in early December was talking about it's way too soon to talk about rate cuts. But then 2 weeks later, he said we're talking about rate cuts. And that further eased financial conditions and has culminated with the most drastic easing in financial conditions on record at a time when the Fed on paper is still supposed to be in that tightening process. And the added complexity to all this is, while the Fed is running QT in the background, we've actually seen a dramatic net increase in liquidity into the financial system from a various type of sources, including the PTFP bank rescue facility that was put in March, the drainage of the reverse repo through which the Treasury has been cleverly funding its record deficit, in the sense that we are in a record non-recessionary deficit spending environment, which we've never seen. And of course, the reversal in yields, which in September Powell said was doing the job for them, meaning higher yields. And then yields collapsed rather dramatically. And of course, all this has led to a, just very powerful rally in equity markets, 20% on the S&P. And all of a sudden, it's all soft landing, happy talk again. And so if you're concerned about all this easing of financial conditions, actually pushing back on the gains made on the inflation front, meaning you're too easy too soon, because all this easing in financial conditions, in effect, is equivalent to about 3 rate cuts already. The market already ran with this, right? And the Fed is not yet at its 2% core inflation target. So if I were them, I would have said, okay, I want to push back against this a little bit. And that's what Powell did. So in this context, fair enough. Whether he actually means it, it's a completely different story, because we've seen Fed speakers say all kinds of things and then do something completely different.
That's the problem. That has been the problem. But they will say that, that they're data dependent and that they're very reluctant to, they clearly course corrected from the fall, but they're reluctant to sort of get too far down the road because, they want to see what happens. They're trying to sort of land that kind of perfect combination where they can slow things down without tipping it into recession, which we know is super hard. Going into this, there seemed to be a real mismatch between what the Fed was saying, even in its forecast, and what the market was saying. As you said, it ran ahead, right? It got way ahead of the Fed. Do you think? Go ahead.
Oh, go ahead.
I just wonder if that gap has been closed or if there's still work to be done. Are they more in line now, or do you think that the market's still pricing in too much easing, too many rate cuts too soon?
No, the gap is clearly still there. I mean, Powell pushed back against the expectation of a March rate cut today, and the market's dialing that back a little bit. But the gap still remains on a fundamental level. And this is where this journey on the macro side is now very interesting and unique, because I referenced that deficit earlier. You know, we have a view that the economy is doing great, and it seems to be doing well. The labor market is holding on, and all that good stuff. But we all forget, and that's kind of missing in the larger debate, when you increase debt by $2.7 trillion in 12 months, and you run a $2 trillion deficit, that is fiscal impulse. It means it actually goes into the economy. If we had a balanced budget, which we never do, obviously, and haven't had it in over 24 years, I believe. If you ran a balanced budget, you would not be running positive GDP growth right now. You wouldn't, right? I mean, for example, in the fourth quarter, GDP increased by a little over $300 billion, while the deficit increased by over $500 billion, right? The government is hiring and has been hiring. Half the jobs over the last few years have come from government hiring, while the private sector labor market actually has somewhat peaked, it seems. And obviously now we're seeing a bunch of layoff notices coming in. So I'm wondering if we'll all not having a look at the real economy, but maybe a little bit over optimistically positive economy. And that leads perhaps to too much enthusiasm quite yet. I'm not saying there's not going to be a soft landing, but I think the body or the roads are littered with bodies and past cycles where you get that sense of optimism about a soft landing. And what we're coming out of, and this is really critical right now, and this is the reasons why companies are announcing layoffs. This period of high inflation gave benefits, companies great benefits for margin improvement, right? Because they were able to pass these prices on to consumers. Well, there's a flip side to that. Now that inflation's coming down, they're losing that cushion. So they are all of a sudden faced with shrinking profit margins. And in order to make up for those profit margins, they're going to have to cut fat, which is employees. It's called efficiency. To the extent you can do all this without any massive layoffs, then that's fine. And maybe you just get a slight tick up in the unemployment rate, and that's that. But that's typically not what happens, right? The historic track record is a different one. You know, you do not have much history at all to sit at 3.5% unemployment, and you're going to remain there, even in the 4% range. That's typically not what happens. But it may happen this time, obviously. We can't know until something breaks, and nothing has broken at this stage.
Yeah, it sounds like you're a little bit worried maybe that the economy is a little weaker underneath than maybe it seems. George just we were just talking about how complex the macro environment is, and it remains that way. We talked about it last year. And George in the chat just brought up a really good point and said yields were down today as hawkish words flowed from the Fed. So we saw the reaction in the stock market to sort of Powell trying to sound hawkish, trying to sort of say, hey, we're going to take our time. March seems very unlikely. We don't really know. We have to see the data. We don't want to blow this. I'm paraphrasing. But yields went down. They didn't seem to have the same reaction. Did that surprise you, or are they sniffing out something that they think is coming regardless of what Jay Powell's saying?
It's a very good question. And it's a particularly good question because what we've seen over the last couple of years is this really high correlation between where the yields are going and where the stock market are going. It's an inverse relationship. So you can even flip charts and just show this relationship. It's beautiful, actually, right? So that's why we had the big flips in market in October of 2022 and again in October of 2023. It's when yields flipped the direction and they started coming down, and that was positive equities. And it may be worthwhile looking at a chart I brought of the 1-year yield, and it goes back decades. And this chart, this was the point I made in early November, which basically said in any given cycle, when you have the peak of yields in a cycle, that leads to a market runway. It's relief, right? Because the peak tightening is over and you get the improvement in liquidity. And so what we've seen time and time again prior to a recession unfolding is you get this market runway that can last for months. It can even last for years, right? And I submit to you that's precisely what we've just seen off of the October lows. In this sense, the market has been behaving very rationally and very consistent with history. It is not until the relief from yields turns into terror, into yield terror, I call it, and actually the lag effects traditionally of rate hikes filter through the economy, and then something breaks in the labor market, and that's typically when the Fed panic cuts rates and tries to re-stimulate everything. I mean, that's the typical cycle, and at least on that measure, what we've seen so far is consistent with that. Now, what we've seen today, in past months, if you saw a drop in yields, you would have expected a positive reaction in equities. Now, is this today a warning sign that maybe we may have that type of relationship shift where this now turns into yield terror and there's an imminent recession? I can't say. I would need to see a lot more evidence of this. This may be a one-day wonder, so to speak. But yes, I would say that we all have to be respectful of the fact that given this massive deficit spending, that none of us have a sense of the real strength of the economy. And keep in mind though, liquidity has trumped everything, and the U.S. government is showing no signs of slowing this incredible debt deluge. Janet Yellen especially came out this week saying, well, maybe we're going to have less funding requirements in the second quarter in particular. Well, we'll see about that, right? Because last year they promised us of a deficit of minus $1.5 trillion, and they came in with one, just about $2 trillion. So they were completely off. And so their own visibility may be a tad limited, right? And there's obviously the debt ceiling had been kicked into early 2025. So in principle, they have an unlimited credit card to keep going. The challenge is, and Janet Yellen, gotta love Janet Yellen. When every Fed speaker was out in the summer and the fall talking about higher for longer, she suddenly came out at the beginning of October and said, higher for longer may not necessarily be a given. And guess what? Soon after that, yields peaked and dropped hard. So I always urge people to pay close attention to Janet Yellen, because she has, as head of Treasury, she has a urgent need for lower rates, because not only are interest payments on government debt skyrocketing, right? They're hitting over $1 trillion this year. But there is a lot more refunding requirements coming because of old debt maturities that were originally financed at much lower rates. And all of a sudden, they're going to have to contend with much higher rates. So this funding beast that is out there, it's only going to get worse. So she needs lower rates for sure. And so there's a gap between market expectations, between the Fed and the market, but there's also a gap between what the Treasury needs. And there's a conflict there.
Yeah,
so the longer the Fed holds on, the
Yeah.
worse it's going to get for Treasury.
Yeah, and we talk about that a lot here on Real Vision. Raul talks about that a lot. That listen, they can't afford to keep rates this high, from that funding lens. So when you're looking at what has to go, it's hard to see it. They can talk about inflation all they want. It's hard to see how that narrative doesn't bend to the need to be able to get those interest payments down. So I want to circle back. So certainly it seems like for all those reasons bond yields are headed lower. Do you have a sense that we're going to continue to see it move lower at a pretty rapid clip? Is it going to front run the Fed actually announcing those easings? Or do you think it sort of just hovers around this, this range below 4 that we've seen it park at when it's trying to figure out what's happening?
Well, this is where the liquidity equation comes in. There's some unknowables on this point because we're facing some real deadlines here coming into March. To the extent that Janet Yellen and her team were able to manage the funding on the short end and thereby using reverse repo as kind of the funding mechanism and that adding liquidity into the system. The reverse repo facility is going to be hitting zero at some point March, April at the earliest. In that context, actually surprised that wasn't addressed today by the Fed. And in that sense, then you may end up with some more pressure on yields. And of course, you got all kinds of concerns geopolitically that none of us can control, i.e. Red Sea. And I am generally concerned, obviously, that financial conditions have eased so fast that may, and then you have the wealth effect from record highs in the main indices, and all this positivity, and before you know it, we're going to see pressure on spending. And remember, the traditional way to beat inflation is a recession, right? Because you bring the economy to a halt, and what they've done here is the economy is growing, better than ever, right? Where everything is great. So if they were able to continue to see lower inflation, which, by the way, if you look at the year-over-year effects, that will probably continue for a few months at least. But there's always risk that we're going the Arthur Burns route from the 70s, which Powell wanted to avoid. But now these events have kind of overtaken the entire tightening process, that we may see a surprise at some point later on. But I can't predict this. So we're going to have to keep a close eye on this, as well as on what's happening with the regional banks now that they've announced that they're going to end the bank funding program in March as well. And we got a little headshot in markets today about that as well, as one of the regional banks got clobbered pretty hard on this. We're all in the view, because we have record highs, that the lag effects from previous rate hikes no longer matter. But when I said earlier, maybe the economy is not as strong as it appears, I would encourage everyone to look at the underlying broader stock market. I have a chart for that too.
Yeah, let's bring up, because you have been looking under the hood at some of the rally we've seen and the nature of it and stuff. So walk us through what you're looking at for stocks.
Yeah, so we came in from October. I was talking about that shift in yields being peak in the cycle, and that would be really bullish stocks. And fair enough, that has so far worked out. And then there was a lot of talk about, okay, we're going to see a broadening the rally, small caps, everything else had been lagging. And we saw some of that into year end. And this chart that I brought with you it's called the Value Line Geometric Index. It's a particular measure of equal weight. And there's different measures on this, but I've used this chart for years because it's been one of those really helpful charts in assessing potential topping and bottoming patterns in markets. And as you can see on the right side, basically, it's actually quite shocking how precise this has been over the last couple of years during this quote unquote tightening cycle. And you have a very, very precisely defined range. And in October, it looked terrible, right? It had broken all down again. Small caps were not following. Everything was bad. But then there was a positive divergence, which I'm not showing here in this chart, just to keep it simple. But there was a positive divergence. That was a buy signal along with the view on yields, and we ripped higher. What was surprising is that it stopped dead in its tracks at the beginning of January. Couldn't get above the resistance that we've seen over the last couple of years. Okay, that's a problem, right? Because if you want a true confirmation of the bull market, you want to see a crossing of that line. You want to see getting above resistance. XVG is a broad indicator of a lot of stocks, right? Mm-hmm. And then the really interesting part is at the beginning of January, we had a little pullback. Okay, fair enough. We were very overbought on a short-term basis. And then another rally to new highs just now in the last week, right? And XVG was not able to get to the January highs. It's made a lower high. That's a negative divergence. Mm. And ironically, we've seen this twice before in recent years. One was right in the lead up to the January 22 top. Okay. The same type of situation. S&P makes new high. XVG does not. We saw it in the lead up to the COVID crash. S&P makes no high, XVG does not. So generally, I would say that's a warning sign. In terms of my earlier comment about the economy being perhaps weaker, if the economy was so strong and lag effects don't matter, why has XVG not been able to cross above that resistance line? While, and we've been talking about this generally in markets for years about the thinning of the herd, the leadership by big cap tech. Well, that leadership has now narrowed even more. I mean, the market cap expansions we've seen in the favor of a very few stocks is absolutely staggering, right? I mean, Microsoft from the October 22 lows to now just basically doubled the market cap, $1.5 trillion. I'm not saying Microsoft's not a great company. They don't have a great story. They do. They're delivering. They have a great story. But all of a sudden, we're looking at a few stocks that control $12.5 trillion in market cap, nearly half of US GDP. That's razor thin. That's razor thin. And in general, I would say you would want a broadening of a bull market. You can't be relying on just a few, because then you get accidents, i.e. Tesla this past week as well. You don't want to lose the leadership. So, while bears have probably been run over, I'd say bulls now have a lot to prove as well, because this is not a healthy picture in general, and it throws in some warning signs.
Yeah, I'm glad you brought that up, because whenever we talk about stocks, we always have to think about how do we need to look at it when it has been so concentrated, in those few names. And we have not, you're right, we have not seen that broadening out that a lot of people, we started to see it in November, but it didn't get any follow through. Want to pause the stock question for 1 second, because we have one related to what you were talking about that I want to make sure I get in from Nick. It's a very good one. Sven, you mentioned deficit spending. A lot of the U.S. states and local municipalities are still flush with cash and have not yet spent the federal money yet. How and where do you see this affecting the market? Could that put a bid under equities?
I'm not sure. I mean, I'm not an expert on state spending, but I would argue in general, government spending has been a great contributor to growth. I mentioned the deficit, but you have major construction projects. You have attempts to get manufacturing back to the U.S., which is conducive for jobs and so forth. I mean, it's tremendous, the amount of money that has gone into. So as far as saying, maybe this whole tightening cycle was a bit of an illusion, right? Because you're tightening on the monetary side, but you're really goosing the whole liquidity equation on the fiscal side. And this is the great experiment now, because typically when you see a big deficit, you see it in context of a crisis that's unfolding. Oh my God, we have to stimulate, we need to support everything. Now we're doing it without a recession at all. And I've no place, because we've never seen that before. And maybe you can argue, well, this is so powerful, it's going to brush over maybe these lag effects, and that's how you can get maybe to a soft landing. I hate to be so bland about it, so that would be kind of a unique government subsidy. In context of all the debt that's been accumulated in the last few years, I got to be honest with you. When we went into this tightening cycle, remember the Fed had just printed money through the zoo, and then were forced to panic rate hike because they had gotten the inflation equation so dramatically wrong. My impression at the time was, well, if they're gonna just coming out of 15 years of zero rates and now they go panic high into the highest debt construct ever, something's gonna break.
That's what a lot of people thought. A lot of people expected that.
But then I got really suspicious. I got suspicious in the summer of 22 when, remember we had the Russia invasion of Ukraine. We had consecutive lows in the S&P. We had wild rallies and the new sell-offs to new lows. Something happened there that didn't make sense to me, and that was the VIX. It kept making lower highs and lower highs and lower highs, even at the October 22 lows. And that's why I came up with the term of this controlled bear market. A lot of people were out there saying, hey, the VIX has got to go to 45 for a proper bottom to be in. Absolutely correct in any historic sense, but that didn't happen. In fact, I came up with a new indicator, and that was basically the Yellen indicator, because every time markets got in trouble, Yellen was out there and she was concerned about something, like the UK Guild and liquidity in the treasury market in October 22. Then she was concerned about the banking crisis. And then all of a sudden in October, she talked about higher for longer, not a given. Every single one of these utterances, if you paid close attention to them, turned out to be key pivot bottoms in markets. Fact. You can call it coincidental.
Well, it's it's the Yellen put, sort of, isn't it? We talked about the Bernanke Fed put. It's the Yellen put.
It's the Yellen put, and so in context, you have to wonder who's really in charge here, right? And so to see the VIX, then last year we saw this again. The VIX just got absolutely monkey hammered. There was a moment where actually it was trying to defend a long-term uptrend from the 2017 lows. It got crushed below, and now we've been sitting in for 3 months in this 13-14 range, which generally is also a bit concerning because extended periods of volatility compressions lead to accidents, especially if you got massively extended charts. So now we're in this really weird situation where we got some stocks that are massively overbought, but we have a broader market that sends signals that it's actually oversold because it is so weak underneath. And I think this is going to make for a really interesting journey here in the next few months to negotiate with them.
That's a great point. So as we close out, what's the pace car here? What sets the tone? Is it the Fed? Is it the economy and maybe consumer behavior? Is it bond rates? Because as you pointed out earlier, that bonds really seem to be dictating. Equities were responding to moves in yields, which whipped all over the place last year. So is that what's in the lead? What is going to determine what happens, particularly to the stock market? Because that's what people are most exposed to.
Well, the key driver to everything, and take the combined picture of everything we talked about, has been liquidity. So we got to keep a very close eye on how liquidity evolves. It's been tremendous expansion in the last 3-4 months. And if that spigot turns off for whatever reason, watch out, right? In fact, I have a chart of the S&P that may be of interest here because I've been tracking this since the very early part of October. And we're technicians, so we're paying very close to technicals. And this cup and handle I pointed out early October, and it just said, unless bears can break anything, this is screaming much, much higher. And I just as a side point, I want to point out, bears had a COVID global pandemic as an excuse. They had record inflation and they had a record tightening cycle as an excuse, and nothing ever got broken. In fact, in October, we had that little dip below that trend line to the COVID lows, and guess what? It got saved as well. I mean, absolutely nothing. It's really fast. That's why I come back to the notion of this controlled bear market, the hidden forces underneath, because they always show up at the right time. And this cup and handle pattern has paid technically absolutely beautifully. And frankly, full conclusion is 5,400. It's got a lot of room higher. Having said that, when you have breakouts like this, and especially very aggressive breakouts, you can make the case that there will be some sort of pulling back and maybe even a back testing. I don't know how much of a back test we will get. It makes sense to me that we would get a back test. Presidential election years have some seasonality. It's a bit shaky into February and March in particular. So if you look at this and say there's going to be some sort of back test, and if that back test holds, and all of a sudden we're massively oversold again, then that's just another big buy signal, right, for the next run. Unless I see something break technically of significance, my view is to basically remain bullish. Obviously, from our perspective, we scale out of longs when things get really aggressive, and then build the flexibility then find spots to add back in. I mean, if you look at this chart, what's bearish about that? Absolutely nothing at this point, right? And bulls remain in control even today. I mean, you just look at the sell-off. Okay, great. What's broken? Nothing dramatic. We're above all the key moving averages. All the trends are holding. Blah 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 blah. We would need to see either an event or a significant slowing in the economy or a break in the labor market. I'm not saying that any of these things can't happen. And that's when you do build flexibility and then scale out on extreme strength, you then have this ability to reassess and see, okay, what's now an interesting technical spot of confluence, for example, that makes sense to dip back in. Right.
Yeah.
And so that's the part of the journey. And I would just, on a closing thought, say that we're in year 4, 2024. I've done some work on 10-year cycles, put that out a few weeks ago. It's kind of fascinating. Year 4 tends to be very choppy with intermittent highs. There will be some corrective activity, but it's preparing for a big year 5. Don't ask me why. But if you look at all market history going back to 1900, the 5th year, no matter where the starting point in the 4th year, I'm not saying a 4th year is necessarily super bullish, but it can be. It also can be bearish. But whatever low you get in the 4th year sets up for a massive, big 5-year up. And if you look forward and say, assume the worst about 2024 if you want, okay, well, what does that mean? What does that mean is that the Fed would come in with ungodly firepower, which they now have, because they're sitting at 5.3% effective funds rate. They can relaunch QE at any time for any excuse, right? If something were to break. And the experience of the last 4 years, and I hate to say this, but the last 4 years have shown that when anything is close to breaking, they're stepping in, as they did in March of last year, as they obviously did with COVID, as they did when the UK Guild had a hiccup in October of 2022. The power to move the equation is awe-inspiring. I hate it myself. I this is not the free market I want.
Yeah, we can debate the merits of this approach. But so I think Chris Delaney had made an observation, and I think Sven just answered your question. So I'm glad we ended on that, which is you can point to all these things that are problematic: high debt levels, the rate reset, maybe the economy's not as strong, maybe we see, because inflation's coming down, companies with less pricing power, there'll be more layoffs. There are all these things narratively that you can see are worrying. But if it all comes down to liquidity and the fact that if any of those things start to go out of control, you're going to get this liquidity story to come in and spend. That's what you're seeing in the charts. And that's why your one part of your brain is saying things are not good, but you got to be an equity bull or at least look for your opportunities on any pullback this year, because there's this underneath this narrative of liquidity that's been driving everything and looks like it's still intact. Is that fair?
That's totally fair. And, I just maybe differentiate that. You just mentioned one side of the brain. One side of my brain is highly critical of the macro workings of the system, because the end result is ever higher wealth inequality, a shrinking middle class, and it just gets worse from cycle to cycle to cycle. But there's nothing I can do about it. And I've screamed and yelled at the system for years myself, but also learned I prefer to make money, and you got to trade the market you have knowing
exactly
what the levers of power are. I don't have to agree with them, but I have to also be cognizant that they exist. And this last October was another prime example. I come back to Janet Yellen. When she all of a sudden said higher for longer is not necessarily a given, and you weren't paying attention to that, that you got run over. Same in March, and same in the October before that. That it's the world we have. It's not necessarily the world we want, right?
Yeah.
But there are warnings. I don't expect this to be a completely smooth journey in 2024 at all. I think the VIX is way too low. There's open gaps on it above. I think we're going to see some filling, but those will create opportunities. That's kind of my general view on this.
That's fantastic. And you're so right. And I think this explains a lot of the conflict and contradictory views and sort of dissonance that is out there. Like, wait a minute, how can this be true on the one hand, but this on the other? And I think that you filled in a lot of that for us today. So we appreciate it. Sven, great stuff. Thank you so much. What an interesting conversation.
Thank you very much, Maggie. It's been a pleasure.
Yeah, great to have you on, and we will do it again soon, please. Fantastic stuff. We're rocking and rolling through this week. Remember, we have non-farm payrolls coming up and Friday, and we have, for the U.S., I should say, even though we have a view on the world, the U.S. kind of driving a lot of what's going on now, so we got to keep our focus here. And it's Education Month, and we are doing a little bit of our spin on personal finance this week. So we caught up with Jared. We heard from James Altucher yesterday. If you haven't seen that, check it out. It's awesome. And then we're going to talk to Raul about this on Friday, which will be really exciting. So be sure to tune in for that. Just a sort of different take. And we call it personal finance, but it's really about trying to achieve some financial freedom, which we are all about. So hope you're enjoying them. Leave comments in. And we will be back same time tomorrow. So thank you. Thanks, Sven. Everybody take care and good luck out there. Today's show is sponsored by Engrave, maker of the coldest hardware wallet Zero and stainless steel backup graphene. Engrave brings you the highest security in a touchscreen experience to safely manage all your crypto offline. Enjoy a 10% discount using the code REALVISION at realvision.com/Engrave.